So here's another indicator for you guys, and I may have mentioned this before, but I want to make it more apparent now. And we're going to talk about bull flags and bear pennants, or bear flags, bull pennants, pennant flag. They mean the same thing. All right. So the first thing that you need to do to be able to identify if it's going to be a bull flag, bear pennant stuff is you're going to want to bring up an average. You don't have to bring up multiple ones, just bring up a moving average. All right. So we'll bring up a simple moving average, and I'll put this at I'll put it at like 15 so it follows the chart very closely. And you can find pennants, flags, you can find them in 30-minute calendars, you can find them in 1 hour, 1 week, 1 day, whatever. I'm just on a 30-minute right now on Stellar Lumen. Okay, so let's take a look. In order for a pennant to be a bull pennant, it has to be a bull market. In order for a bear pennant or bear flag to be a bear pennant or a bear flag, it has to be a bear market. And I actually want to follow this chart a little bit more closely. So I'm going to do moving average, and I'm going to bring this down to like a 10. So it's following a period of 5 hours because we are in a 30-minute. So that'll probably be a little bit better. Okay, so we have our average here. We can see that this market rate in here is bullish. We can see that this market rate in here is bearish. So I'm just going to show right here that that's a bearish market, and I'm going to show that right here is a bullish market. Okay, we see that? So we've got our bullish market here and our bearish market here. Now what a pennant is in a bull market, I'm going to address the bull market first. What a pennant would be in a bull market, it can only exist if the market is above the moving average. What essentially is happening is it's a breakout into a consolidation. A consolidation meaning a slowdown or a decrease in volatility and volume, and then back into a breakout. So in order for a bull pennant or flag to exist, it has to be above the moving average, and it's going to be a breakout into a consolidation, which is an area of low volatility or volume, and then back into a breakout. So I'm going to show you an area where there's actually a bull flag occurring. So right here we see our breakout. Okay, well, it goes like this, and then it consolidates right here, right in this area. There's a consolidation. And the consolidation is going to be very concentrated, okay? It's not going to be spread out over hours and hours and hours and hours, because if it was, it'd look like a lopsided flag. So here's your flag pole right here, and then here's your pennant, here's your flag. So we have a breakout occur, and I'll zoom in a little bit. But we have a breakout occur, and then a consolidation, an area of resistance briefly. An area where it's testing and deciding if it's going to continue failing, then it breaks through. So we have a breakout in a bull market, a breakout in a bull market into a consolidation, a decrease in volume, and then back into a bull market again. And you can actually see down here where there's some volume areas, and then volume picks up in the green, and then it slows down and it picks back up. It's faint, it's small, but it did happen. So this is a bull pennant in a bull market, and it's above the moving average. It would not be a bull pennant or flag if it was a correction. So be very clear on that, guys. A pennant is not a correction. A flag is not a pullback. It's a consolidation. It's not a correction, it's a consolidation. So this would not be, say the market actually went from here and it dropped way down here, and then it continued picking back up. Well, that would have been a correction or a pullback, but that's not what happened. It consolidated. It decreased into this small space, and then it broke out through it. That's your bull pennant. All right? How can you take advantage of that? One of two ways. One's risky, the other one's less risky. And once again, it's not as risky if you're using more than 2-3 indicators, right? You want to use at least 3. So this would be indicator 1. What you can do is you can buy in the consolidation, literally right in there. You can buy in the consolidation, or you can validate the pennant when the bull run follows it. So you can buy in the consolidation, or you can validate your analysis when the market continues to go up shortly after the consolidation, in which point you pay a little bit more. But you buy right in here, and then you continue riding it out until you sell at the top. So buying in the pennant, you're not going to give your analysis a chance to validate itself. But what you're saying, you're effectively saying, okay, I believe this is a bull pennant. I believe this is a consolidation. I'm going to buy, and I believe that it's going to break out after this. Or you can go, you know what? I'll wait it out. I'll wait for the pennant to form, and then I'll see an increase in volume following this pennant, and I'll buy on that increase to validate my analysis, and then I'll likely see it continue to go up. So that way is a little bit less risky. Up to you what you want to play it, how you want to do it, okay? So that's oftentimes going to be a good point of entry into a market to make a good trade. And you will see this on swing plays, and you'll see it on scalping plays as well. Now, what about the bear? What about the bear pennant or flag? Okay, well, here is a bear market right here. This is a bear market. And I can actually see a couple consolidations. I can see one here and I can see one here. Once again, it's not a pullback. It didn't, come down right here and then ping way back up. But you have your flagpole right here, and then you've got your consolidation right in there. You also have a flagpole right in here, and you've got your consolidation right in there. And once again, very concentrated. If it had consolidated way, way, way over here, that wouldn't be a consolidation. That would just be an area of resistance. That would just be a long, dragged out tug of war between buyers and sellers. But this right in here is definitely a bear flag here and a bear flag here. Now, what would a bear flag do for you? A bear flag is a consolidation during a bear run or a bear trend. In order for it to be a bear flag or pennant, it has to be below the moving average. Bull would be above, bear would be below. So you establish that moving average, then you identify your pennants. Is it bull, is it bear? Now, a bear flag is a downtrend or a run into a consolidation followed by a breakdown. So it's a bear trend or run into a consolidation followed by a breakdown. Well, a bull pennant or a bull flag would be a breakout into a consolidation followed by a breakout or a break up. Now, this is definitely a time to recognize that the market will continue going down. So this would be an indicator that, okay, let's wait. Because you might be thinking, okay, relative to the rest of the market, good time to buy because it's way down. But then you see a flag form and you go, you know what, I'm going to wait it out, because if that flag validates itself, it will continue into a breakdown, and then it will hit a bottom. So it can be a good indicator if you see a flag form, and then you see it continue to decrease. You might follow that decrease down to the bottom, and then enter in here, and then sell at the top. And then it continues decreasing, goes into a bear market or bear trend for a time being, and then a bull pennant forms, and you choose to whether you choose to enter in the pennant or after the consolidation on the breakout, and you re-enter here and you sell here. That is your bull pennant, bull flag, bear pennant, bear flag, flag pennant mean the same thing. And once again, never trade with one indicator, always have at least three. But these could be good indicators as to if the market's going to go up or down, and they could serve as good entrance points and good exit points. We'll see you in the next video.